We'll go on now to Michael Masters, who is the chairman, Better Markets Incorporated.
I always have to adjust the height. Good afternoon. My name is Michael Masters. I'm not a oil minister. I'm not an academic. I am a hedge fund manager. And one of the things that I do, and I've done over my career of over 17 years as a hedge fund manager, is study money flows. I find that it's imperative to understand the role of money in markets, because after all, money is what moves markets. And so therefore, I came to some prominence on this subject when Senator Lieberman's staff called me a few years ago and suggested I come up based on some work we had done on money flow, and I subsequently testified to the Senate and the House, the Commodity Futures Trading Commission of the United States, the Securities and Exchange Commission, and the Financial Crisis Commission on this subject and other subjects. And I'm here representing Better Markets, which is a nonpartisan, nonprofit organization dedicated towards financial reform. And my experience in Washington helped me understand that there wasn't really an advocate for the public in terms of financial markets. Unfortunately, the financial markets are complex. It's a bit like it was here in the Middle Ages, when if you didn't speak Latin, you had a bit of a disadvantage in argument. And today, the financial markets are often very much in Latin, and therefore it takes someone with financial market expertise to advocate on the behalf of the public, because in many cases, they're unsure what to advocate on. And in fact, if you think about the name Better Markets, it really means that markets can be better. Our view is that markets need to be more transparent, they need more regulation, they need accountability and oversight. And the idea there is for markets to represent the public's interest. After all, the markets are made up of human beings. Human beings have flaws. Even though Adam Smith says there's an invisible hand in the market, it's imperative that we look into the markets and we understand that, in fact, markets are just human creations. They're not a god, and they need to be addressed as such. And so hopefully by making better transparency, we can benefit the entire public on market structure. So in that line, I'm going to talk today about the role of money in the crude oil markets and the crude oil derivatives markets. And it's first imperative for people that may be somewhat unfamiliar with markets to understand how, in fact, markets allocate. And in fact, there's a buyer for every seller and a seller for every buyer, definitionally, in any transaction. That's the only function of markets, really, is to match buyers and sellers. And the way markets do this is via price. Markets allocate via price. And so there's not a certain amount of selling at a price, then the price moves up to find and incent the sellers. After all, the sellers are not going to do this for free. They have to be incented to sell, and vice versa on the buy side. So markets move up and down via the price function, and they match buyers and sellers. And that's the same with commodities. Even though in commodities derivatives you can create an infinite amount of futures contracts, you can only create a finite amount at any given price. After that, the price must move, and of course that's the issue we're all dealing with here is the price movement. And so in commodities markets, just like in any markets, money matters, because that's what moves prices. And so I'll talk a little bit about the derivatives markets and the history of financialization, the financial investment into the commodity markets. And this just shows a chart of West Texas Intermediate, which is one of the benchmark crude oil contracts since 1995 to today. And you can see the open interest was roughly about 500,000 contracts of open interest for many, many years. And then suddenly in 2004, 2005, it spiked up, where it's remained up around 4.5 million contracts of open interest. And this doesn't include Brent, and most of my all of my comments here will pertain to WTI. And the reason for that is that Brent didn't provide us any information. ICE and some of the other groups did not provide us transparency until after 2010. So we really don't have any historic information there. And in fact, this shows a particular type of derivatives investment, commodity fund investment, which is large pension funds and institutions, endowments putting money into the commodities markets. You can see that there's been a quite significant, and it really started around 2004. You may ask, why did they suddenly put in all this money in the early part of the decade? And the reason is because they had historically high equities allocations. They didn't really have any alternatives to speak of, and they were looking for an alternative, if you will, a place where they could get perhaps equity-like returns without correlation. And for an asset allocator or for a big institutional investor, the nirvana, what they want is an uncorrelated asset that has alpha, that can grow, that has outperformance. And in this case, many institutional investors were sold a bit of a bill of goods by investment banks during the time. And I'll go through the history quickly. This just shows the commodity index fund investment. This is in barrels, so it's not in dollars. The last chart was in dollars. This shows barrels, and you can see the impact. You'll notice the big spike down in 2009, and people say, well, if these institutions were interested in investing in commodities for a long period of time, why did they suddenly decide to drop out in 2008 and during the financial crisis? Well, the reality was that most of the way these institutions invest in commodity indexes is via the swap market. And to have a swap market, you must have a counterparty. And as you recall, in 2008, in the fall, Lehman Brothers went out of business. AIG was teetering. Most of the other investment banks were teetering. And so a pension fund or a large investment advisor didn't know if their counterparty was going to be good. And so they closed out these contracts. And in fact, nearly $100 billion, of which about 70% of that was crude oil and its derivatives, came out of the market in a space of about 3 or 4 months, as people closed their commodity index positions because they were concerned about the counterparty risk embedded in their commodity index swaps. And this is also in barrels, taking out the dollars. This shows flows. This also includes ETFs and commitment of traders nets back linked. Let me just go back one slide because I think I missed one that was an important one. This really talks about the history of commodities as a new asset class. There was a paper published by 2 professors that was sponsored by AIG, which was still is a large financial products company. Many papers you'll find about these markets are sponsored by investment banks, and predictably they have very interesting conclusions that generally benefit to the investment bank's interest. And so we saw this huge inflow of investment capital from institutional investors. We then saw it go into other areas in terms of commodity-linked notes, commodity ETFs, single commodity swaps, new TTA funds. And the problem with this is in this search for non-correlation, companies, institutional investors have ended up driving correlation. So commodities which used to not correlate, which was the purpose of the paper by Gorton and Roundhorse to incent people to come into these markets, they do correlate, because once everybody does something, then it changes the nature of that. And today, this is an example. This is open interest of going back to '96. This is a single date. We could have picked a lot of dates, but very similar. Open interest. This is a CFTC categorization. You can see the non-commercials. That's the speculator, if you will. From the CFTC data in 1996, roughly 7% in West Texas Intermediate crude oil. 7% of open interest. Open interest is roughly ownership of a commodities derivatives markets. And today, in March 6, 63% of crude oil contracts were held by speculators, and only a little over a third, by hedgers. What does that mean? Increasingly, the pricing determinations of the benchmark crude oil contracts, which all of the spot contracts, or many spot contracts, are priced against these two benchmarks, Brent and WTI, are more and more driven by inflows and outflows of institutional investors and speculative forces versus traditional supply and demand the way it used to be. And in fact, this is probably the most important chart that I have, and this shows the correlation with the S&P 500, with the Goldman Sachs Commodities Index, and the West Texas crude oil. And this goes back to 92, and you can see since really 08, in 07 you've seen a climb, and then really 08 and 09 and into 2012, you've seen this much stronger correlation. And why is this important? It's important because the fact that if these markets are now correlated, whenever risk comes back on, whenever uncertainty is reduced in the world economy, and the markets, the financial markets, the capital markets do better, then by virtue of the fact that they're correlated and these enforced by algorithms and HFT strategies and other kinds of financial innovations, crude oil will participate. So crude oil is linked now to the equity markets in many ways. And what does that mean? Well, that means if we have a bull market in equities, we may have a bull market in crude as well. But the problem with that is that this crude oil bull market ends up becoming a brake on economic growth. And so then crude oil falls, and then equity markets fall, and everything's linked together. That's a very significant problem, because if they're linked together, how in the world can we ever have any kind of equity market that's reasonable? So this, to me, is the most important slide. Once this correlation breaks, you'll know that financialization is no longer an issue. But as long as it's here, it's a big problem. And in fact, in West Texas Intermediate, these large commodity index traders who, after all, roll their positions, they have to roll them over and over, have changed the forward yield curve of commodity derivatives. They've changed where these markets used to be historically in backwardation, this idea of normal backwardation, which was prevalent in most of the 80s and 2000 when these contracts were first developed, has changed, where it used to be we used to be backwardated roughly 2/3 of the time, and in contango a third of the time. Today those are reversed. Almost 70% of the time today we're in contango. And the reason for that is we have these enormous amounts of money that are constantly rolling every month that have to sell one contract and buy the next contract, which helps force us into contango. And of course, futures markets affect physical prices. The futures markets aren't the only thing that affect prices. The spot market has an effect as well, of course. But the futures markets have a very significant impact. And the reason they have an impact is because many contracts, some of the people that do hedge in this room, use the futures markets to deal with their basis. So they may have a basis swap on top of their futures benchmark, but we use the futures markets as benchmarks. That's why we have them. That's why they're called benchmarks. And so generally when the price moves up in the futures markets, you generally get a similar move in the spot market very quickly. And the problem with this, of course, is when you get invalid price signals, when you get price signals that are predicated on financial flows rather than supply and demand, you get resource distortions, because financial flows are fickle. What happens when pension funds decide, for instance, that because of the contango and the yield curve and the fact that these markets are now correlating and not correlating like they used to, decide to come out of commodity index investments? It's going to be a big change for the markets. And so it's imperative for everyone here to understand the role of these large institutions and their activities in the financial markets. And of course, we're getting more and more studies talking about financialization. There's been some studies that have said, of course, dollars having any effect on the price in the commodities markets, which I find somewhat laughable. But there's also new studies now coming out and saying, peer-reviewed studies that are saying, in fact, dollars have had an effect. And oftentimes, as I mentioned before, it depends on where those studies come out for the conclusion you get. But in this case, this was a recent study from the University of Illinois and George Washington University, and they looked at contemporaneous actions by commodity-linked notes, by the hedging of these notes, and we found, or they found, I should say, a very statistically significant persistent impact on commodity prices. And they also found a monotonic impact, which means the more money that came in these markets, the larger amount of price variation one generated. Chang, Karolinko, and Wong in 2012. Karolinko, people may know, he's the chief economist for the CFTC. He looked at the financial crisis and looked at the activities of speculators in 2008, and the unwind of these swaps, and found, in fact, that they actually created a lot of volatility. This is important because if we have another financial crisis and people worry about counterparty risk because presently we have an uncleared swaps regime around the world with very little transparency, then we may be in a similar situation. And then Hamilton and Wu looked at our methodology and found that it was sound. And even though his conclusion was that the money going in and the money coming out was just coincidental with the price going up and the price coming down between 2007 and 2010, or excuse me, 2006 to 2009, even he found the methodology was sound. And so what to do about this issue? Well, there's several things. There's, first of all, at Better Markets, which I'm representing today, we advocate a comprehensive position limits regime. Holbrook Working, who did some seminal studies about the commodities market, found that an adequate level of speculation was roughly about 25% of open interest in the futures markets. And if you think about it, people will say, well, if we eliminate speculation or we limit speculation, we're going to limit liquidity. And as you'll recall, in the 90s and even in the 80s, certainly in the late 90s, there weren't many people complaining about liquidity in many of these markets. There was plenty of liquidity at the time. There was plenty of speculative liquidity at the time. And in fact, Wall Street always says that we need more liquidity because they want their presence more so in these markets. But the reality is liquidity is a bit like aspirin. If I take 2 aspirin, I get one effect. If I take a whole bottle, I get quite another effect. And so the idea is to have enough speculative liquidity to provide for the primary constituency of these markets, which is you, the hedgers, the most consumers of these markets and suppliers, but not have so much liquidity where we have price formation that's damaged, which has indeed been the case recently. And so we also advocate eliminating the commodity index funds entirely, because what we think is that commodity investment should go into the means of production rather than inventories. After all, commodities derivatives really just represent inventories. And in fact, doesn't it make more sense for large investment institutions to invest in the means of production rather than the fruits of production? The means of production, the investment, more exploration, more investment in energy, rather than investing in derivatives on the commodity investments themselves, which is much more profitable for Wall Street, but much less profitable for the actual investor themselves. And of course, here with the MiFID process coming up, it's imperative in Europe that we have an effective position limits regime. We have a new pro forma position limits regime in the United States that I think will be helpful, but we need Europe to go along and match that so we don't encourage regulatory arbitrage. And so it's imperative that governments in Europe go along with their proposed MiFID framework to have a strong position limit regime, and that institutional investors also are engaged directly. Sovereign wealth funds and other people are engaged so that they will invest in the means of production, in solving the problem, in new production capacity, rather in equities, for instance, rather than in the oil inventories themselves where they cause distortions in the price discovery process. Thank you very much.
Thank you, Michael Masters, and I'm glad that you started your discourse by telling us that money market issues are spoken in Latin. I think some of us are now down to French. Having said that, I think it was important, very important, that we actually got a clearer understanding of the speculative market. as they relate to oil prices around the globe.